Hello, I'm Tony Marino, President and CEO of Tenaz Energy. I'd like to review with you our NOBV acquisition. We've created a combined deck here for the existing company and NOBV, but I'm just going to really stress the slides that are associated with the acquisition that we announced last week. I'll point you to investment advisories and disclaimers we have at the end of the presentation. Point out, first of all, on slide 3, the existing company, same management team and very strong board as before. On slide 4, no change really to our existing guidance that we have. We would continue development in Canada with a flexible budget, continue evaluation of CCS in Netherlands. We placed a number of valuable hedges on our production for existing gas production for 24 and 25 in Netherlands and Canada. Certainly a big emphasis of the company will become integration of the NOBV assets, heading toward a mid-year 2025 projected closing date, and we'll be continuing our M&A efforts in other areas on our pipeline of transaction prospects. Production mix for the existing company before combining in NOBV shown on the lower left, combination of Canadian oil, TTF, and a portion of 6-to-1 production that comes from our AECO gas production, and the guidance for production and CapEx shown on the lower right. Now let me shift to the main purpose of this presentation, which is to discuss the NOBV acquisition. First of all, on slide 6, summarizing the attributes, we do think it's a transformational acquisition in line with our stated strategy for our company. Secondly, creates a very significant operated position in the Netherlands North Sea. Will be the second largest operator in this region. Thirdly, we do think it's a high rate of return acquisition that should add value for our existing shareholders. Fourth, it is high margin TTF gas with a number of hedges at very strong prices that should generate reliable FCF. And finally, post-transaction will have very low leverage, and we'll show you a couple different ways of looking at that later in this presentation. On slide 7, we summarize the assets. First of all, on the left, they're world-class reservoirs. It is primarily Rotliegend production, Permian age, moderate depth around 3,000 to 3,500 meters. These are reservoirs that produce in a large geographic range in northwestern Europe. They're well understood. We think they're pretty predictable. And we think that the projects that we have available to improve the production profile are well identified and should be able to provide a reliable improvement to the profile that we have today. Secondly, very important, a superior operating base in terms of both facilities and personnel. We visited a number of the offshore platforms and the onshore plant. We're delighted with the condition of the facilities, very well maintained from an asset integrity standpoint by a high quality operator in NAM, which is owned by two of the largest and highest quality energy companies in the world, Shell and Exxon. Most importantly, we're very excited about bringing in the NOBV personnel that we've met, both offshore at the offshore platforms, at the onshore plant, and in the asset office. This is really the key to the deal for us. We've got a great set of assets, but what is most important is bringing in that staff to work on these assets, apply more capital, and improve the production and margin profile going forward. Thirdly, we get a lot of very important infrastructure. Again, this is a process is about the production itself is about a fifth of what is produced in the Dutch North Sea, and it's a lot of onshore processing capacity built for the higher volumes that these assets produced at historically, and therefore we think not that much infrastructure investment required for the ongoing stream of projects that can improve the production profile going forward. And finally, on the right, these predictable fields are of moderate permeability. They're not ultra-tight gas reservoirs, and as a result, they have a quite moderate base production decline of around 10%. You combine that low base production decline with historical underinvestment and a large number of identified workover, optimization, development, drilling, and exploration opportunities, and it makes us quite optimistic about the production profile going forward. Moving on to slide 8 to summarize the transaction. First of all, on the right, we show the map that will result from this acquisition. Existing Tenaz licenses shown in blue, non-operated position that we already had, combined with the NOBV production licenses in yellow, strong operating core here, and the NOBV exploration licenses shown in orange in the northern part of the block, and the pipeline infrastructure that connects these. It's about 11,000 BOED of production, about 54 million barrels of reserves on an oil equivalent basis from 6 producing hubs and over 3 BCFD of onshore processing capacity. So for this, the combination of this production level with the existing Tenaz brings us to about 13,800 BOED on a pro forma basis. That would be about a 4x increase over existing levels. Free cash flow up even more dramatically. If you take our estimate of free cash for 2024 with the existing strip and the hedges that are in place of about 130 million Canadian, we would have about a 24x increase over existing levels. We'll summarize the deal in greater detail later, but basically the initial purchase price is 165 million euros at 1/1/24. During this interim period between the effective date of 1/1/24 until our projected closing in the middle of 2025, we think we will generate around 125 million euros, again, depending on prices and a variety of other factors going forward. When you take out our deposit that we paid, that would leave us around 30 million euros of closing payment if it occurs as projected in the middle of 2025. There's a contingent earnout payment as well based on the cash flows from 25 to 27. I'll detail that in a minute. And there's 2 other contingencies for prices well above existing levels and for significant new field exploration discoveries. There would be a royalty, and I'll talk about that later as well. Financing discussed in the bottom left part of this slide. This required cash to close is going to be sourced from cash on hand and a new National Bank credit facility. We will have a delayed draw term loan plus revolver of about 110 million of 110 million Canadian that will provide closing. And we don't expect to need to issue equity to close this transaction. Moving on to slide 9. The assets acquired, summarized again here, several producing areas. The split between these for production shown on the pie chart at right, and the reserve base as well in the McDaniel report at 1/1/24 at the PDP 1P and 2P levels. The production base notably is 87% operated. That's very important to us to put in place the kind of development program that we think is appropriate with a remaining life of over 20 years. Midstream and onshore processing assets are very important. We acquire ownership in several important components of this, and we operate the entire onshore facility, a photograph of which is shown on the lower right. Moving to slide 11, I'm going to now detail the consideration for this transaction. The base payment is 165 million euros at January 1, 2024. It's going to be funded by that quite significant interim period cash flow, 23 million euro deposit that we've already made. There will be working capital and other customary adjustments in the acquisition agreement, and that brings us to that 30 million euro cash at close that I talked about a minute ago. The earnout is shown on the lower left. So this earnout is a set of contingent payments that are based on the annual cash flow for 3 years, 2025, 26, and 27. Out of free cash flow, meaning cash flow less CapEx and ABEX expenditures, one half of that for 25 would go back to the seller, one half for 2026, and one quarter for 2027. There is no minimum earnout payment. It's just based on the annual number for each of these 3 years, and the maximum level, cumulative level that can be paid is 120 million euros. If we don't get to 120 million euros, there's no remaining payment that Tenaz will owe. I think that's a good structure, which reduces risk to the Tenaz shareholders and also cuts the amount of upfront consideration that we need to pay. The exploration upside contingency is shown on the upper right. On a new field discovery, a brand new discovery that we might make, if the cumulative production reaches a pretty large level, about 18 BCF, we would begin to pay a royalty to the sellers. That royalty steps up to a max of 10% if we produce 35 BCF from a single exploration discovery. So certainly if we make a discovery of this size, we would have expected to have considerable value to the Tenaz shareholders before these royalties would kick in. There's a price contingency as well, as shown on the lower right. Threshold level for this price contingency is about 50% above existing prices, around 22 Canadian per MCF. If prices get to that level, between about 22 and 26 Canadian per MCF, there would be a 25% sharing of the after-tax incremental cash flow for that price wedge to the sellers. And above about 26 Canadian, that sharing with the sellers would go up to 3/8. So again, at that, like the exploration contingency, were this price contingency to kick in for any one of these calendar years, 28 to 31, we will have presumably received quite significant additional cash flows to the Tenaz shareholders, and this component of the consideration terminates at the end of 31. So these are all the components of base and contingent consideration to acquire these assets. Mechanics and funding shown on slide 12. Again, we talked about the effective date. We get the cash flows at closing, beginning with January 1, 24. We based all of these numbers for a mid-year 25 closing, could vary somewhat from that timing. We already discussed at some detail the way the initial purchase price will be funded and the expected cash required at close. We discussed as well the financing on the upper right, funded by the NBC facility. It would be our intent to replace that delayed draw term facility with other appropriate debt financing that would be consistent with our long-term capital structure objectives. And to complete this slide on the lower right, we discussed the pro forma leverage. We've shown two columns here. The one on the left does not include counting the earnout toward that leverage. Remember that there is no minimum payment that is required, just that 120 million euros max. If you don't include it, the company would be projected to have no leverage at close. If you want to count that 120 million euros toward our leverage ratio in its entirety at the maximum level, then that would be a 1x debt to pro forma FFO result for that metric. Turning to slide 13, we just detail the hedging arrangements that are in place. In total, this is about 46% of the existing production profile for NOBV for the 3-year period, beginning with January 1, 24 through December 31, 2026. The prices for each of these hedging instruments, primarily swaps, but also a collar for Q4 24, shown on the right column, at very strong prices compared to what we are used to seeing in North America. Moving to the pro forma section, beginning on slide 15, we just talk about the reserve report. Independent report done by McDaniel for these assets has an effective date of 1/1/24. It uses the most recent three consultant average price deck per TTF to estimate the values. The reserve waterfall on the lower left showing the buildup from PDP reserves of 31 million through 2P reserves of 54 million barrels equivalent. The table speaks to the future development capital included in the report and the resulting pre-tax and after-tax NPVs in Canadian dollar terms. On the lower right, we show the production profile for the next 5 years from the McDaniel report, which has a limited amount of development drilling included in it, and no exploration activity included in this report at the 1P or 2P levels. The asset base, we do feel, includes a large number of investment opportunities as shown on slide 16. Seismic coverage is very important to that. Really, the entire asset base that we are acquiring from NOBV or from NOM has 3D coverage. We think it's high quality data sets. There's a particularly high quality data set that has just been shot over the last couple of years in the JDA area, the largest of our producing hub areas. And this is a OBN or ocean bed node 3D. And what that means is just that the geophones are placed directly on the seafloor rather than trailing them behind a ship in the water. Gives much higher quality data signal. And this data set is really still just being processed. We're looking very much forward to the interpretation. Typically, when you can get such a high quality seismic survey, you're able to much better define the development and drilling opportunities for existing or stranded fields, and often identify a number of exploration prospects as well. So we're very excited about having that OBN. There's a wide range of development opportunities, tie-in opportunities, and exploration on the existing data set, including the very large high potential block in the northern part of the asset base that on this and the previous maps was detailed in orange. And even on that northern block, I would say pretty good proximity to existing infrastructure. If we make a discovery, not that far to tie in even the northern exploration blocks to the existing gathering and processing that would take it to Den Helder. So we think there's a great deal of potential beyond that is currently identified in the 2P report. So putting it all together with the existing Tenaz assets on slide 17, in the Netherlands, a combination of the existing non-operated asset base plus the NOBV assets would bring us up to 55 million barrels equivalent as at January 1, 24 of 2P reserves. That's a RLI of 13 years. We have contingent and prospective reports already established for the non-operated assets that we own today. We have not yet commissioned same kind of reports for NOBV. So what we show here is really only for what we, for contingent and prospective, is only what we currently own in Netherlands. We continue with our 21% equity ownership in NGT. We add to it ownership in the Den Helder processing facility, and point out that the midstream alone would have generated around 10 million euros of cash flow for the last couple of years. In Canada, we have our existing asset base at Leduc Woodbend, including the new Waterlet plant and that leasehold. Great deal of development potential identified already in the REX. We think we've expanded that with the new leasehold in Ellerslie and other intervals, and we'll continue that Canadian development. Pie charts on the upper right, first of all, for production, NOBV shown in the dark blue, the existing Netherlands in the gray color, and Canadian production, both oil and equivalent gas in the light blue color. For FCF, on the right side, we've done it by really product and segment here. TTF gas shown in the dark blue color, combination of NOBV and the existing assets. The midstream, very small sliver today, and WCS crude in the existing WCS in the Canadian based operation shown in the gray color here. Pro forma combination for production and free cash shown in the middle of the slide. Company would be nearly 14,000 BOED with NOBV added in today, around 150 million of free cash, both very, very large expansions of what we have in the portfolio today. And the pro forma reserve summary in the lower right, putting together NOBV and the existing assets in Canada and Netherlands, would lead to a 2P total reserve at January 124 of about 68 million barrels equivalent, and under the consultant price deck, over a 900 million Canadian ATAX NPV 10. So a much larger company, of course, with the new assets added in. I'll speak very briefly in the remaining slides to the vision of the company. Really, we feel that this is an acquisition that very much matches what we had originally set out to do in Tenaz. We feel that we did use our technical and commercial capabilities to bring in an asset that has quite strong return metrics, a good production profile going forward at a reduced risk profile to Tenaz because of the structuring of the transaction. We feel it should be very accretive for the existing owners. Certainly, it extends our acquire and develop approach in conventional assets in the overseas market, and very consistent, I think, with the asset type and characteristics that we originally sought to bring into the company. And certainly, thirdly, fits with the free cash flow objective of the company and can help support a balanced capital markets model going forward. I'd say these assets are very much underfunded historically, with a large number of projects that should be high return and can improve the production profile going forward. It is this type of cornerstone acquisition that we originally sought, giving us a real regional focus in the Dutch North Sea, and one that we would hope to build through organic activities and some potential also for acquisitions going forward. On slide 20, definitely in line with the geographic focus of the company originally identified, Europe being the highest priority. And we do feel that we were able to find a high rate of return base acquisition that has a great deal of opportunity for improvement in the production profile going forward through the investment stream that we've identified on the property, on the set of properties. And as a result, that combination should give quite a high return on capital. And in summary, Tenaz continues to identify and attempt to bring in some of these deep value opportunities in the international market. Secondly, it is in line with the experience set that the Tenaz team has historically, and we think that it's a type of asset that should allow us to continue to execute on each of the elements that we have in our corporate strategy. And finally, the management team remains very much aligned with the investor set. We do think we have made a transaction here that should add to the value of the company for our existing owners. So, final point, I'd ask you to note the disclaimer and the advisory on forward-looking statements that we have on slides 23 and 24. We thank you for your attention, and we look forward to the next opportunity to speak with you.